Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. And as usual, we are thrilled that you could join us this week because it's an important update. We're going to go through our playbook, how we're tackling the shifts that are taking place in the overall stock market, and how we're really excited about the moves that we've made recently and how energy in particular is very well positioned to do well in the current economic recovery and as it relates to how everyone else is positioned in the overall market. But we're going to go ahead and get started. And ladies and gentlemen, the bottom line here is the economic rate of economic activity is continuing to improve. That rate of change that we always pay attention to. And how does this relate to how we look at asset allocation? Well, it's quite simply, we want to look at the new stocks that are in new emerging positive trends on those dips in the market or in those stocks in particular. We want to use that as moments to buy those stocks. When we see other stocks that have exited positive trend and have entered negative trends, such as technology, we want to use those rallies to unload that unused or unwanted inventory in an otherwise bearish trend. Second, the overall velocity of economic activity is improving. What does that mean? The price for stuff in general is going up. So we want to be long the companies that are selling those goods or that stuff that is going up in price because that's good for their business. Now, what happens when stuff moves up in price? The 10-year yield goes up. And what happens when the 10-year yield goes up? Well, ladies and gentlemen, we get a reallocation of assets within the stock market. We see that the US dollar overall, when combined with high deficit spending, so high deficit spending, a higher 10-year US yield is bearish US dollar. It's bad for stocks that we call dream stocks. So those technology stocks where they're not even realizing revenue for the next few years, high multiple, high growth stocks tend to underperform in that type of environment. So we want to be sellers of those stocks, buyers of the banks, buyer of the oils, buyer of material stocks. Quite simply follow that playbook. And I think that we can generate some decent outperformance if executed correctly. So that's overall the playbook. We don't want to overthink this. When rates go up, when the dollar comes down in value, we want to be long the price of companies that are selling stuff that goes up in price. Why? Because it's priced in US dollars. So let's move on here. ISM manufacturing cycle highs. This is the rate of overall manufacturing activity, ladies and gentlemen. Not only is the overall index at cycle highs, which is, again, of course, not suggestive of a recession anytime soon, but new orders is at cycle highs. And when new orders is at cycle highs, that is suggestive that the rate of change of growth is not going to slow down anytime soon. Then we look at the activity pipeline. We get way down into the weeds, ladies and gentlemen. We look at the what's called the activity pipeline. So the ISM new orders plus the backlogs minus the inventories. The higher the number is, the better it is for future growth. Remember, we want to pay attention to the future, not the past. So when inventories are lean, guess what happens? So let's use a great example here. A store. If the store runs out of shirts and pants, guess what? They got to order more shirts and pants so that they can sell to more customers. So when those inventories are lean, retailers and stores and businesses in general are out there buying more merchandise. And when they're buying more merchandise, that sustains economic growth. That's good for the economy. That's good for stocks that are economically sensitive. And we see that across the board here, whether it's ISM manufacturing, business production, new orders, employment. We see here, and this is the box that I've created here, what we see is the overall 3-month, 6-month, and trailing 12-month rate of change is accelerating all the way through to today. When it's accelerating, that is not suggestive of a slowing economic environment, and certainly not an environment where yields are going to come down, and so we want to be long secular growth versus some of these more cyclical names. So rate of change going up, sell the US dollar, buy commodities, buy banks. Let's keep it simple. When I say buy commodities, buy oils in particular. That's the sector that we like the most right now. We also see that weakness playing out in the US dollar as it relates to the various crosses, right? So the renminbi is going up in value. For 20 years, the renminbi, or China in particular, has been an exporter of deflation. As labor costs have been super cheap in China relative to the US and Europe, US and European companies have manufactured in China, and those lower costs have been exported in the form of lower prices to the US and Europe. But now that labor costs are going up in China, and now that the renminbi is going up in value, we can expect that reflation to be exported back to the US. And that's taken the form of, guess what? When the renminbi goes up, what goes down? The other side of the trade, the US dollar. When the US dollar goes down in value, what goes up in price? Stuff priced in US dollars, commodities, oil, copper, you name it. Anything that's priced in US dollars is going to go up in value. So that means we want to be long those assets. What happened in 2001 when China entered the WTO? US dollar peaked out. Not because China entered the WTO, that just happened to coincide with a peak in the US dollar cycle. And so started the commodity super cycle of 2000 to 2011. This is has potential for the restart of another commodity super cycle. Weak US dollar plus the rebuilding of Western infrastructure. In particular, we love energy. Why? Because everyone hates energy and the fundamentals are improving. We always want to beware those strategies that are based on hyperbole. No one uses oil. Come on, that's a ridiculous statement, ladies and gentlemen. How many of us have gone to the gas pump recently? We use a lot of oil. Energy's in a 13 bear market. Companies are terribly managing energy, right? Energy kills the planet. There is no shortage of arguments why people don't want to buy energy here. That's great for us. That's great for those who own energy, such as our clients. Why? Because the bar's been set super low and no one owns it. At some point, the fundamentals get reflected in the share price and fund flows reverse out of technology and toward those areas of the market that are basically not owned at all. That moves the share price upward and to the right, which is what we want to see. So we want to buy those assets where the bar is set super low. This chart says it all. We're using more oil than we've ever used before. We're just coming out of a pandemic and barely below the 2019 peak. By the time we get to the back half of this year, what's going to happen? We're going to set a record for the most oil ever consumed in a given year. This is very important because right now the suppliers of oil, the energy companies, can't respond. Why? Because the government's cracking down on permitting in the name of ESG and the environment. That means oil prices go up. We want to be long those companies that are drilling today and don't need new permits. Also, to maintain production, we got to reinvest in capital expenditures, right? We got to maintain the servicing of those wells. That's good for the oil supply companies. That's why we've moved money into that overall space. And the most important point, ladies and gentlemen, there's just no substitute for oil. I know we talk about battery technology and electric cars and all this other stuff, but the grid, the overall battery or electricity storage, it's just not there. The infrastructure doesn't exist to support a wide scale move away from oil. Could that happen in 15 or 20 years? Absolutely. But as you know, my first mentor in the industry once told me, long term, we're all dead. So in the very short term and in the medium term, over the next 5 years, there is a potential for a very, very bullish setup for oil prices and for oil service stocks and for E&P companies in the oil production space. So this is why we are so bullish on energy. And quite frankly, no one owns energy. But guess what? You do right now. We look at the technical picture. We broke Brent crude. So the way that oil is priced overseas, broke above 70 this week, approaching 70 here on WTI. That is opening the way from a technical perspective up to $75, $80 for the price of oil. Again, look at oil service stocks going back 10 years. We're like 60% off the highs. So this is a very, very good setup for the overall space as it relates to alpha and overall performance. And then, of course, what's the catalyst? Well, historically speaking, when we ran a regression analysis, when the price of crude is around $70, historically, oil service stocks, typically from a historical standpoint, trade closer to $600 on that oil service ETF versus that $280 that we're at today. over time, as the recovery becomes sustainable and sticky and real and people doubt it less, we believe that that money, as it flows out of technology, will find its way to that oil service ETF. And so that's good for the individual stocks inside that ETF, and that's what we own. We can see it here in the weightings. 2008, tech was 19%. Where's the bubble? We can see the bubble, 37%. Tech and communications now in the S&P 500. What happens when this weight goes down? That money's going to go somewhere. It's not just going to be burned away. It's going to go somewhere. It's going to find a home. Where's it going to find a home? Those under-owned areas of the market that don't have capacity for new money intake. So energy, the banks, materials, these sectors that have been in 10-year bear markets where the fundamentals are improving, they're under-owned, and they're cheap and represent a decent long-term trade where the fundamentals, the technicals, and the overall ownership trends align to be able to generate alpha. And of course, the credit markets are healthy, ladies and gentlemen. Literally nothing's happened. We haven't updated the chart. Why? Because this remained flat. So the credit markets, the foundation of the financial markets are healthy. We see no signs of any real danger percolating, despite all the fear we hear in the press. So overall, let's take that playbook. We want to buy sell-offs in energy in the banks and then use rallies in technology to unload that unattractive inventory. Overall, the economy is getting better. Don't overthink this. Buy economically sensitive assets. Higher deficit spending is dollar bearish, so we want to buy assets that are priced in US dollars because that'll go up in price. Therefore, the stocks will respond in kind. And of course, more spending, lower US dollar, good for oil, banks, and the materials as we just mentioned. So thank you again for all of your business, for your trust, your friendship. And if you have any questions, please reach out to your advisor, or you can reach out to us at 888-543-3776, or you can reach me on my cell phone at 858-354-5114. Thank you again and have an absolutely fantastic weekend. And we look forward to having everyone attend next week at this time, same place, same time. Talk to you soon.